Hello, I'm Sarah Bickers on INT's Community Education Team, and today we're going to be talking about navigating debt repayment. In this presentation, we're going to go over our money beliefs and behaviors. We're going to talk about how to navigate different financial situations, and we're going to talk about different debt repayment strategies. When we're approaching this topic, one of the first things we want to think about is our beliefs surrounding money. Our beliefs about money are hugely responsible for the financial decisions that we make. These beliefs are often learned in childhood. They're things that our parents might have been taught from their parents, so on and so forth. They're also often unconscious. We're not always going to be aware of our money beliefs at first, but doing some work to bring them to our awareness can really help us make financial decisions that are going to work best for us, knowing our unique selves and our unique beliefs. They're also often partial truths. There's a reason why we might believe these things about money because of experiences that have happened to us in the past or experiences that happen to the people in our lives. But they're not always wholly true, and knowing which ones are helping you and which ones are hindering your plan can be really powerful. They're also responsible for those financial outcomes. They are hugely influential on the decisions that we make, how we approach different situations, and just knowing about our money beliefs and recognizing which ones might be preventing us from reaching some of the goals we have can help us make decisions that work through that and then reach the goals that we have. So if you realize that you have money beliefs that might be negatively impacting your financial plan, there are some steps you can take. Step one is to realize when they happen. Just start bringing that awareness into the picture. Start thinking about the money beliefs that you have, what they are, when they're showing up, and how they're influencing you. Another big tip is to take some time before making decisions. This can help us fully process what is happening, what the decision is, and how to go about it. So one big tip is to just wait 24 hours before making a purchase, especially in an unplanned one, and maybe even longer for some big decisions. Another thing that can be really helpful is checking in on your finances on a regular basis. Going through, seeing what's happening, kind of getting a picture of where you're at and how you're progressing towards your goals. Financial experts recommend you check in on your spending plan as often as possible. At minimum, they kind of recommend that you do so once a quarter, so every 3 months or so, but once a month, the more the merrier. It can just really help you get a picture of where you're at. Another thing that can help is setting SMART goals. SMART stands for specific, measurable, attainable, realistic, and time bound. SMART goals help people reach their goals and monitor their goals because they are very detailed. There's a way to know that you're reaching the goal that you have, you know how to measure it, you know how to see your progress, and that realistic piece is really key here. That realistic piece also comes in when creating your budget or your spending plan. We want our budgets to be something that we can actually follow, that includes our unique selves, includes things that we might want occasionally, is really realistic to our big picture and the goals that we have. So, creating a personalized budget, creating one that's realistic, can really help you stick to your financial plan, and it'll help you reach those goals and last long term. Another thing is to continue your education. Checking out this video here is one key step. We have a lot of other resources on our education center, from articles to calculators to live webinars, etc., that can be really helpful in working toward those financial goals that you do have. After you start to become aware of your different financial beliefs and behaviors and how they might be influencing your financial decisions, taking a look at your cash flow can be really helpful in figuring out where you are, especially in relation to any debt repayment that you might need to navigate. Your cash flow, simply put, is your income, for the money coming in, minus your expenses, the money going out. And there are really only two ways to improve your cash flow. Way number one is the one that we recommend because it can be easier to start with, and that is to decrease your expenses. So, to spend less, cut spending here and there. We'll talk about some ways to go through it. Way number two might be a little harder. We'll talk about this as well, and it's to increase your income. So, let's dive into different ways to decrease your expenses. Now, this mostly comes up in situations where you might be shopping, we need to buy things. And so when you are looking at decreasing shopping expenses, especially, there are several things that you can do to help save you money while still meeting those needs and wants. One thing that you can do is be aware that stores, their job is to try to sell you things. They have marketing strategies, they have different tactics from the layout of the store to samples to music they play that are trying to get us to spend money when we go into stores or go online. Just being aware that their job is to sell stuff and our job is to stick to our financial plan can be really helpful in making decisions that are going to help us stay to our plan and reach those goals, and know that they're going to do a lot of things to try to get us to spend, and just being aware of those can help. The next thing is to look for items that we might have already and maximize what we have. I can't tell you all how many times I've gone to the store, I've come back, I've gotten to put the item up, and I'm like, there's another one right there. I already had it. I didn't need to buy that thing. So before you go out shopping, before you go to buy something, search around your house, see if you have something, see if there is something that you could use in lieu of that item already, an alternative that might be cheaper, more affordable, and that can also help you when you need to go buy that thing. Look for those different alternatives as well when making that purchase. Another thing to do is to just have your plan and buy only what you need, i.e., stick to that list that you have, stick to that plan. That can help prevent you from caving and buying some things that those stores are trying to get us to buy a little impulsively. Another thing that you can do is have that list ready and have a calculator. A lot of the times we might overspend because we're not aware of how things are adding up as we go around. So as you go shopping, as you go through that store, if you're doing this in person, have that calculator and add up items as you go along so you're really aware of that total, aware of what you're dealing with before you get to the checkout. And then if you're shopping online, keep an eye out for that total. Usually they tell us, but just monitoring that, and again, coming back to taking some time before making financial decisions can really help. And then another thing to do is to shop online, generic, and seek discounts. So, shopping online helps because we're less likely to be influenced by some of those in person store tactics I mentioned, but they will still absolutely try to do things to get us to spend more impulsively that we need to watch out for online, like have flash sales, deals with countdowns, things like that, showing us other things that they're selling. So, just being aware of those online tactics, but online does help with some of those in-person factors. So just know which one works better for you there. And then online also helps by showing your total as you're going along. And then the generic piece, brand names, they spend a ton of money on marketing. And a lot of the times the items are very similar, if not pretty much the same as the brand name when they're generic items. So just challenge yourself if you tend to buy brand name items to try some of the generic and see how that goes. See how you save money, see how you feel about those items, because that can be a great way to cut down a little expenses here and there that can add up over time. And then seeking discounts as well. I said earlier, looking for alternatives, just seeing if you can get specific items for less, seeing if there are sales, looking for coupons, having the browser add ons that give you discounts and show those along the way. But also be aware that sometimes sales and discounts are trying to encourage us to buy items that we might not need. So taking that time and asking yourself a lot of questions can be key here. So, with that, looking into those discounts, making sure you really need that item, but using the ones that are going to help benefit you when you do know that that's an item that you need or really want, and just trying to get the best deal for that overall. All of these different strategies can help shopping in person, shopping online, any sort of ways to bring those expenses down. But when we're looking at cutting expenses, just reviewing what you're spending on, keeping an eye on it, checking in on that plan and thinking, how could I get this down? What's really, really important to me? Coming back to your values can be key. But sometimes cutting expenses might not be enough to improve our cash flow. Sometimes we might need to look at different ways to increase income or just other ways to improve our cash flow in general. So, one thing you can do here is to focus on some long term goals. Maybe we're not in a situation where we need to improve our cash flow super immediately, but we would like to improve it long term. So, thinking about ways to move forward in your career or maybe changing your job. Where do you really want to go long term? What are those big goals? And what are the steps that you can take to get there? Another thing that you might want to look into doing is just evaluating your budget. What's working for you? What's not working for you? What's helping you on that plan? And what's kind of hurting you there? And finding some ways to try to maybe rearrange things to help figure out what your real priorities are and reach those goals that you do have. In the short term, or anytime we might need some extra cash, selling something might be a good option. This could be something as simple as a garage sale, or something that kind of looks like maybe renting out a car that you might have that you're not using that much, or a room, something big picture, something alternative that you might not have thought of, but that can help maybe increase our cash flow a little bit in the short term, especially when we have things that we're not using. Another option here is to get a second job or a side hustle. I absolutely acknowledge that this is not easier said than done and not realistic for a lot of people. So know yourself, make sure you're taking care of yourself in other ways, know your energy. But if you have passions that you're into, ways to make cash on the side, that's absolutely something to explore because there are a lot of options out there to do so. And then working with the scenario you're in, maybe if there are opportunities to work overtime and make more cash, or asking for a raise, just negotiating that current position can help you increase your income over time. Just doing some research on the going rates for your current positions and having that negotiation can really help. After we look at ways to improve our cash flow, be it decreasing expenses or increasing income, we want to talk about how to navigate financial transitions. So these are things that might come up. They could be as major as losing a job or something like just regular old inflation. How to navigate these things that come up and some things to think about. The first thing that we'll want to think about is, how long is this financial change going to last? Is this something that could be a month or several months? Is it maybe a short term change? Or is this a major life change, a major financial transition that we're going to? And we need to really rethink the whole picture. Knowing how long that will last will help inform you of what path to take that will help you reach those goals and get through that transition as best as possible. The next thing to do is to create a new spending plan. So go through the at least the past 3 months of expenses, see how you're dealing, acknowledge that new change, see what it's going to look like going forward, and figure out what changes you might need to make to work through whatever this financial transition is for however long it might last. After we create this new plan and start thinking about this a little bit, we might need to look at ways to overcome that deficit. So this comes back to that cash flow piece of, where can you cut cost or increase income? What might we need to do to get through this situation? One thing I want to acknowledge with financial transitions is that change can be really, really hard. There's a cognitive bias called our status quo bias that refers to how humans, just because of the way we work, like things to remain the same. We really resist change. It can be something that's really challenging. So, when going through financial transitions, overcoming that cognitive bias can be one of the most challenging things we try to do into coming up with this new plan, because we got used to how we were living before and would like to continue to do so. Just acknowledging that that is something that we're going to have to work through as part of this process, and trying to focus on values, focus on long term here, focus on ways to get through this and that support, and come back to what are the most important things to you can be really, really key in editing your financial plan and getting through these financial transitions. And in doing so, maybe asking yourself, what were we spending on before that we don't need to spend on anymore? If I moved or did something that kind of mm, changed my financial picture a lot, how could that help me in other ways? How that might that impact me in certain ways? Just thinking through a lot of those questions and knowing that this is a really challenging thing to go through, but that comes to step 4, finding that additional help. There are a lot of resources out there to help people through whatever they may be going through. We recommend United Way 211 because they're a great organization that helps you connect with resources for any challenge you might be going through, any transition you might be experiencing. And then know that your friends and family, the ones that are close to you, the ones that you can trust, are hoping to help you as well. Leaning on those resources that you have can be really key. And then step 5 here is, after we get through a lot of this financial transition, as we're going through this, don't forget to keep in mind of preparing for those next transitions. Having an emergency fund, some sort of what if fund set aside can help us through a lot of different financial transitions. It may take time to build that up, but including that as part of our spending plan going forward can help us for those what ifs in life. And then really focusing on those goals, those priorities, those things that are really, really important to us, like our values. Now, after you've thought about your cash flow, your money beliefs, how to get through financial transitions, and all of these components, now it's time to talk about different debt repayment strategies. And with this piece, I want to note that debt can be really stressful. It can be expensive and limit the amount of money that you can put towards your life and your goals. And with this, when we're focusing on different debt repayment strategies and starting to think about how to approach this, there are a few things to keep in mind. One is how you navigate this, what you believe about this. Those beliefs are going to be really, really important to come back to and just acknowledge as part of this process. And then paying down debt can help free money up in the future. So figure out what those goals are, what's most important to you here, to figure out what strategies are going to work best and what your timeline might be here. After you think about some of those questions, then it's time to get organized with your debt repayment. So when you're starting with this process, you want to sit down and gather information about all the debts that you might have as part of this process. You're going to want to get any credit card debt, student loan debt, medical bills, home and auto loans, and take a look at that big picture here. After you do that, you want to, for each of these line items, figure out your balance, your interest rate, your payment, and your term. So what are these factors you're dealing with for each of them? And then with the debt repayment strategies I'm about to talk about, you're going to want to plan to cover the minimum balances for all of these to start out with. And then after that, you want to look at your financial plan and figure out what funds you might have available to help pay these debts down faster, to help free this money up in the future. After you get that information ready, then you can pick your debt repayment strategy. The first one we want to talk about is the snowball method. So how the snowball method works is you are going to arrange your debts from smallest balance to largest balance. With this, you make all those minimum payments that I mentioned, and then you put that extra amount toward the smallest balance first. So that way you're getting rid of that smallest debt item. You're crossing a line off your list, and then you roll up the payments that were going to that smallest balance into the next one. And it kind of snowballs from there as you're paying more and more towards those different large balance debts as it goes up. And that way, small debts are paid off quickly. You get rid of those line items, you check it off. It can give you a confidence boost. It's motivating. You can see those things go away. And it can be a really great thing to do and see those things get crossed off and just watch as you progress through these goals. Another debt repayment strategy that you can choose from is what's called the avalanche method. So in this method, you make those minimum payments that I mentioned, and then you take the extra amount that you have to put toward debt repayment, and you put it toward paying the highest interest rate debt next. So you're going to arrange your debts from highest interest rate to lowest interest rate and put those funds toward paying off your highest interest rate debt. And then after you pay that one off, you roll it up and put it toward the next highest interest rate, so on and so forth, until you cross those items off the list. With this strategy, you're eliminating your most expensive debt first, so it can save you money over time, but depending on your situation, it might take a while to get through your highest interest rate debt. So some folks prefer the snowball method because they're able to cross things off the list, have that motivation, have that confidence boost, and get through them that way. While some folks prefer the avalanche method because it's eliminating their most expensive debt first. It just might take a while and kind of be harder to see that progress because of that. But pick whichever strategy works best for you here. Now, another thing to consider, especially if we're dealing with several debts, like a lot of things on this list, is consolidation. So consolidation works well for folks that typically have several debts and they have good credit and are able to take out a new one new single loan to cover all of those different debts and consolidate them. So it helps reduce the number of things on our list, helps maybe make it easier to manage, and ideally reduces the amount of interest that we're paying overall. With consolidation, make sure you're only consolidating what makes sense. So if you have several high interest credit card debts and one lower interest loan, we might only want to consolidate those high interest debts and leave the low interest one out of that picture, depending on what interest rate we're getting with the consolidation loan. With this, that one payment can be easier to keep track of. Again, ideally lessen that interest that we pay over time. So it can help us with that management piece a little bit and a little bit with that financial piece as well. Another thing to think about with debt repayment is maybe look at refinance or loan modification. So both of these terms are going to be changing, but there's a little bit of a difference here. So refinancing is essentially taking out a new loan with better terms. So a better interest rate, a better payment schedule, better terms in general, and it's reevaluated based on your credit and your repayment status. So if interest rates have gone down or you have a better credit score after taking out an original loan and would like to kind of refinance that, get your monthly payments down, get the amount you pay over time down, refinancing can be a great option to look into to help you save some money there. A loan modification is a change to the original terms of your loan. This is typically done in the case of somebody facing financial hardship, and what it might look like is sometimes it means extending the term of the loan. So paying that amount out longer over a longer period of time. And in that scenario, someone would pay more in interest because of that, but it would bring their monthly payments down. Again, this is typically reserved for those times of financial hardship. Something is happening and you're having a conversation with your lender to see what you're able to do to make those payments more manageable. All of these scenarios I just talked about are for when you feel like you have a good grasp of your situation. You feel confident in managing it yourself. If you've gotten to a place with your debt where you're not so confident, you're not sure about managing that, and you need some help, there are programs out there to help you. We just want to point out a few differences between some different kinds of programs. So we're going to look at the difference between debt management plans and debt settlement programs. So with debt management plans, you're going to this company and you're saying, hey, I'm having trouble managing my debt. I'd like some help here. And they're going to help you manage your debt. They're going to negotiate for you. They're going to maybe try to get lower interest rates. They're going to make those payments to your different creditors. And as they do this, lines will be closed over time. Those lines, as they're closed, as they're paid off, might have an initial hit to your credit because you're still making payments. Your credit will build back up over time. With debt settlement programs, how it works is you go to this company, you say, hey, I'm struggling with my debt. And what they do is they have their lawyers send cease and desist to your creditors. They say, hey, we're going into this period of negotiation. We're not going to pay right now while we try to figure out what we're doing. During that time, your credit lines go to collections, and the goal here is for these companies to try to get your creditors to settle for less than the original amount due. So if you originally owed $3,000, the goal here is for them to get to settle for less, maybe $2,000 as an example. With that, once that period of negotiation is reached, you would pay out that settled amount, but there are a few side effects to be aware of. One is that during that period where you're not making those payments, it's going to drop your credit score. So that lack of payment has a huge negative impact on our credit score, and we'll see our credit scores go down during that time because those payments aren't being made and they went to collections. Another thing to note is that reduced debts are taxed. So that difference between what you owed and what you actually paid out is considered taxable income. So keep that in mind. And then another thing to keep in mind is that settlements do show on credit reports. So anytime you might need a loan, something in the future, those creditors in the future are going to see that you've settled in the past, and it could influence their decisions about offering you products in the future. When you need help with your debt, there are all these different programs out there. Just to know what they mean and try to pick one that's going to help you with your financial situation as best as possible. If you do find that you are looking for some support in figuring out debt repayment plans, one great place to get started is with our financial coaches. Our financial coaches at INT can help you with budgeting, with credit, with savings, and with that debt repayment piece. They are free. You don't have to be a member at INT, and they are non-sales driven. Our coaches are really there to help you figure out a financial plan that's going to work best for you and help you reach those goals. If you would like to meet with a financial coach in person or virtually, you can go ahead and scan that QR code and schedule your appointment, or go to int.com/financial coaching to learn more. Thank you all. I hope you learned a good bit about different debt repayment strategies and financial beliefs and how they influence us, and cash flow as well. I hope you all have a great day, and please join us for some webinars in the future. Thank you, everybody. Bye.